Good morning and welcome to this Monday, April 25th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Welcome, everybody. I hope everybody had a great weekend. I do have a special guest today. I think many of you will recognize this name, Greg Schnell. He's a fellow contributor over at stockcharts.com. He's been writing there alongside me and many others for several years. Does his own shows over at Stock Charts. You need to check out his blogs. But he's in town visiting me today, so I thought I'd bring him on the show. So welcome to Trading Places Live. Greg, good to have you.
Hey, thank you, Tom. Yeah, I look forward to listening in today. It'd be great.
Yeah. So what we're going to do today, I'm going to go through and just talk a little bit about what happened on Friday, bring you up to speed a little bit this morning, go through a couple of charts, and then I'm going to bring Greg in. He'll talk a little bit about all this rotation we've been seeing and give you some of his thoughts, what he sees in the market. I think it'll be a great show. So let's go ahead and jump in. I do, as I always like to do, I'm going to take you over to Earnings Beats first, and especially for those of you that are new to the show. If you go over to earningsbeats.com and you scroll down, we do have a free newsletter. I'd love to have you join. All it requires is a name and email address, no credit card required. You can unsubscribe at any time. This is a 3 times a week newsletter that goes out normally around 8:30 Eastern. So we try to get it out about an hour before the market opens. And it's a very simple read, usually just a couple of quick paragraphs and a chart. And we try to focus on the things that are important to us, like earnings, relative strength, gaps, candlesticks, price volume, trend lines, channels, all those types of things. So if you'd like to check that out, again, it's free, completely free, no credit card. All you need is a name, email address, and we'll get you started. All right, so let's talk a little bit about Friday, because it was a bad day. No matter how you slice it, we had the Dow Jones down almost 1,000 points on Friday, 981 points. We haven't seen those kinds of down days in a while, but the Dow was down almost 3%. S&P 500 down 2.75%. NASDAQ down 2.55%. Mid caps 2.66%, and small caps 2.47%. It didn't matter where you were. You were pretty much going down on Friday. It doesn't show it here, but the volatility index absolutely exploded again to the upside. That's never a good thing, because I always look at that, when we get a rising VIX, that's normally a sign of impulsive type selling. So it's just indiscriminate. The VIX, if you didn't see it, was up almost 25% on Friday alone, jumping up to 28.21. So that's going to be a problem, I think, as we head into this week, that rising VIX, because a lot of times technical analysis, technical support levels, when things get really frenzied and crazy and panicked, a lot of times support levels don't hold. And so I try to call bottoms using sentiment indicators like the VIX, like the equity only put call ratio, which, by the way, was the highest we've seen in the last couple of years on Friday. All of a sudden, a little bit more panic starting to come into the market. So we do need to be aware of that. From a sector perspective on Friday, all 11 sectors were down. So it wasn't which ones performed well. I always like to give you the sectors that perform well. These are the ones that performed least bad, if you will. The staples down 1.57%, utilities down 1.68%, real estate down 1.79%. Those were your quote unquote winners on Friday. Not a good look. Of course, defensive groups were leading, but they almost always are leading when the market is selling off. When you see the defensive groups leading on the way up, that's when you've got problems for sure. And that's what we saw back in December of 2021. Of course, that last final move up in the S&P 500 was led by these three groups, along with healthcare. And that's not what you want to see. The weakness on Friday centered everywhere, but maybe a little bit more skewed toward materials and healthcare. Materials down 3.75%, healthcare down 3.65%. Again, when you look at these down moves, they were very, very pronounced on Friday, and it was across all the major indices and all of our sectors. So just not a very good day. In the bond market, give you the latest here this morning, 10-year treasury yield currently at 2.82%. That's down 8 basis points. But before you get too excited, less than 2 months ago, we were down at 170. Now we're at 282. So we've been seeing this 10-year treasury yield rise. The interesting part is normally rising interest rates result in rising financials relative to the S&P 500 and rising industrials relative to the S&P 500. We saw none of that. And we've seen none of that really over the past couple of months. So that's just underscoring to me that interest rates are rising for all the wrong reasons. Normally, when interest rates are going up, a lot of it has to do with a strengthening economy, or at least the anticipation of a strengthening economy. Both of those things help financials and industrials. Industrials, the primary benefit is your transports. If the economy is going to strengthen, transports will ship, you have more goods being shipped, so transports do well. In the financial arena, normally rising interest rates create wider spreads and better net interest margins for banks. And also banks, if the economy is strengthening, can lower their credit losses, the estimate for credit losses. So these things normally, rising interest rates normally send these two groups up to new relative highs, and we just haven't seen that. So that's a little bit of a warning sign for me as we continue to move on. And we've got some big economic reports coming out later this week. So just to give you a quick sample, not really much out today, but tomorrow we've got March durable goods coming out, the February Case-Shiller home price index, the FHFA house price index, consumer confidence, new home sales, all of that will be out on Tuesday. And then what I think could be the biggie of the week is Thursday. We're getting the first reading of Q1 GDP. Now, last quarter, the final number was 6.9%. Right now, the estimate for Q1 is 1.1%. So we're already expecting a major slowdown. I'm not sure, but I think it's possible we could see a negative number. I'm not going to go on record predicting it, but I think it is possible. And I'm not sure how the market's going to react to that. I think the market already has been reacting to the probability or at least the possibility of a recession. But I think if we started to see a negative GDP actually come out, that could really spook the market. So just be careful this week. As I've been saying throughout this year, just please be careful about the market right now. All right, let's move on and talk a little bit about the S&P 500. I wanted to show you, first of all, you can see this kind of impulsive selling. Big red filled candles. That means you've got selling all day long. And the one on Friday, I thought was particularly bearish because we gapped down and that was essentially the high of the day. And you can see the bottom of the filled candle is very close to the low of the day. So it was just selling all day long. And if you haven't seen it the last 2 days after we had that gap up right here, that was with Tesla's earnings last week. Once we had that gap up, got the first 10 or 15 minutes out of the way, all we have been seeing is distribution. And that's one thing that I've talked about throughout this, this weakness is it's okay if you gap down and then we get a little bit of buying intraday, because to me, that's, maybe a little ambiguous, maybe a little accumulation taking place. When I see days like this, 2 days in a row of just indiscriminate selling, that makes me a lot more nervous about what could come. So I'm still expecting us to get another breakdown. I think we are going to break down below that February low, at least retest it. We're not far now. Literally at the pace we're going, we could be there today. So let's see what happens, whether or not we can hold this February low. But I think we're starting to see that sentiment turn. Down here at the bottom, you can see the volatility index. That was the day we saw on Friday. So we now reached the highest level on the VIX that we've seen in probably about 5 weeks. Do we go all the way back up here to the 37, 38 level where we marked those prior bottoms? Well, I don't know. Certainly could. So we'll see what happens. Now, let's talk a little bit about the sector rotation. On Friday, just talked about it, but you can see what was leading: consumer staples, utilities, real estate, what was lagging. But let's look year to date. So first of all, year to date, Energy has been a big winner in 2022, no doubt about it. Utilities, consumer staples, still holding on to gains for this year. Real estate, healthcare, another couple of defensive groups, losing ground, but not too much. So right here at the top, and then you have materials. So at the top, you have your 4 defensive groups, and then you have energy and materials. Year to date, look at what's at the bottom. Communication services, the worst, then technology, consumer discretionary, financials, and industrials. Those are our 5 aggressive groups. And of course, you could say, well, the market's been going down, so that's why these 5 groups are leading. Well, yeah, I mean, that's definitely true. That's normally what you see when the market sells off. But let's go back 6 months. This takes us back to the end of October. And check out the 5 groups that are in negative territory. Industrials, consumer discretionary, technology, financials, communication services. Here are your aggressive groups. This dates back and includes much of the bullish fourth quarter. And still, you see the huge disparity. So with that, I think that's a great lead in to bring in my guest today. If you did come into the show just a little bit late, I got a special bonus for you for here at Trading Places Live today. Greg Schnell, who is a really good friend of mine and also someone who has been contributing over at Stock Charts for many, many years, writes blog articles. He writes for Chart Watchers. He has his own blogs. He has his own shows. And Greg's visiting me this weekend down in South Carolina. And so I thought it'd be great if he'd come on the show with me, and he agreed. So Greg, welcome back to Trading Places Live.
Hey, thanks, Tom.
So I thought what we would do, maybe for our viewers, they hear from me all the time. So why don't you give your take on what's been going on this year? I mean, go wherever you want to go. I know you've been very bullish on energy, and energy's had a great year, but you've turned, you told me you've turned a little bit more cautious on the group. So maybe start with that, or start with whatever you want. But what are you seeing right now?
Well, so one of the things, energy's been going up for 3 months, which is nice. What I would actually expect to happen here in order for us to start getting a bid in the other groups, and we've got Microsoft and Google tomorrow, we've got Meta or Facebook on Wednesday, we've got Apple and Amazon Thursday, we've got 3 railroads this week, we've got some of the oil companies like ExxonMobil, Phillips 66 all report on Friday. So there's a lot of stuff coming at us that'll be pretty influential. And I think just, we got the up news on Tesla, great earnings, all that kind of stuff, and the market sold off hard. So it didn't, for most of us, it wouldn't make much sense. I would say that Bitcoin, I was surprised at its resilience actually in the last week. It hasn't really fallen that hard. And if you look at the NASDAQ and Bitcoin, the charts pretty much overlay each other. The NASDAQ 100 and Bitcoin, if you took the last 20 days or whatever, they're basically the same chart. So as a rotation, I'm kind of looking to start to see technology like just XLK versus XLU on a 60-minute chart just start to make some sort of a turn. And we're not getting that yet. So hey, that's Greg, what I'm, yeah.
Do you want to pull up your screen? Do you want to show any charts? Do you want
sure,
me
I could do that.
Charts up for you?
Sure. Let's just grab that. Okay, so let's go to, okay, so here's one chart that I think is pretty important, this XLF to XLU. And again, we can get rid of all the indicators on it. We're not really focused on the indicators. We're focused on this chart shape. And you see this big downtrend. This is financials to XLU. If that downtrend starts to break, to me, I think that would be a real positive. So I pretty much just snap a trend line on that and be looking for that to end. And if we start to see a break on this, and I don't know if I'd go like this or if I'd actually keep it up here, somewhere in this zone, but if we can start to get through here, that will mark a turn. I noticed on the chart Tom put up this morning for the 10-year that we're starting to break the uptrend, the steep uptrend that was on there. So that was the TNX. And so this trend line here will be tested this week. And again, the yields have been going crazy. So this little break, if we zoom in here, sitting right down here, let's just watch and see if this pops. Because if all of a sudden we finally get some relief on the yield side, that could be a big change for us. So I'm watching closely to see if these ratios can start to turn, if the yields can start to turn, and those types of indicators, because the sentiment is awful, and just it doesn't stay awful for a long period of time. So so what I'd like to kind of describe is how we're going to get this bottom, and it usually comes fully washed out, right? Everybody just kind of gives up on buying. This is a chart I use for buying and selling my energy stocks. So the way I operate is I don't try to hold Tesla for 2 or 3 years or whatever. I try to hold things while they're going up and just step aside when they're not. So the oil, and don't get me wrong, oil sounds great and all that kind of stuff, and it has been going up. I think in July it'll probably be going up again, but I step out and then step back in is the way I like to trade it. So when all 5 of these, which is the oil services, exploration and production, energy, the bullish percent index for energy, and the actual price of oil, when everything's above the 20-day moving average, this is a pretty nice place to get long. And you can see that, XLE, it would have been a pretty easy ride. What we got on Thursday, Friday was like a real kind of capitulation where crude oil isn't doing anything here, but the oil stocks are letting go. And again, it just needs a pause. It's been a crazy good run, basically since the beginning of the year. So I'm looking for this turn, and literally out of one sector that might be overbought, energy, into a sector like technology that has been sold off hard. That to me would be the kind of clue we need to actually see some pickup in activity. So again, that TNX trend line is almost breaking. Bitcoin hasn't broken down very hard. Let me just put that Bitcoin chart together. I'm just going to clear this off. So if I look at Bitcoin, and again, it's just a risk, just a risk on indicator is what I'm looking for here. So Bitcoin is trying to hold this base and it's leaking lower. When you put a 60-minute chart on here, it gets pretty compressed. So we'll just open this up a little bit. But Bitcoin is sitting, I'm just going to turn volume off. Oops. Bitcoin's sitting right near its lows here, and we want to see this hold down in here. Now, if I take the NASDAQ and overlay it, let's just grab price here and add NDX. We're going to put it behind, and let's just make a solid line in blue. And we're going to change this from candlesticks to a solid line in, let's say, red or something, just so we can see the difference. But the idea being that when we get these two are moving so close together, and the reason you see some of these flat lines is over the weekend when the NASDAQ's not open, but Bitcoin is. But they're moving together. So essentially, I'm looking for a turn in this risk-on group. So I would draw a trend line either on the NASDAQ or on Bitcoin. And if we start to see that turn, I think that will mark really a big rotation out of energy into Bitcoin, and hopefully not necessarily into Bitcoin, but into NASDAQ 100. Again, we've got those 5 big names reporting this week. And I think that's really going to be the crux of the matter for us. But again, once the news gets really ugly, then I would expect more buyers. I'll call it people afraid to get in, and yet the large money starts to push back in. So
hey, Greg,
yeah.
I was just going to ask, do you look at any of the other cryptocurrencies besides Bitcoin? Do you look at Ethereum or any?
I've been following Ethereum too, but the big thing for me, let me just go grab my newsletter. On one of the things that we see in Bitcoin is a very serious pattern, and whether you use Ethereum or not, or the other ones, they all kind of come together. And I'm sorry about the scroll. Let me just get down here to my Bitcoin area. Sorry, just trying to find the chart. There it is, Bitcoin Daily. So this is one that You can see that this is a pattern that was marked from a guy named Ed Carlson, and he got it from Ed Lindsay way back in the 30s. But essentially, you have all the market kind of climbing up, and then you do this off the high, you come down hard, you basically try to wander up, and then the market breaks. Well, we have this same pattern on Bitcoin that we've seen. And the real question is, can it hold here, or does this let go? And if this lets go, I don't think it's just Bitcoin. I think we see the NASDAQ, we see everything kind of tumble out of here. So I'm watching all of the cryptos. I don't want to say they're moving together, because some of them like Luna and XRP are doing better. But the movements in the cryptos are leading us down this road of, risk on or risk off. So I think it's just a good, even if you don't invest in it, it's a good place to go looking for what is risk doing. And the one thing I will say on Bitcoin is it didn't do anything on Friday. It basically just stayed sideways. And so while the indexes were selling off, Bitcoin held in pretty well. And I think once we get through these crypto, or through this sell-off, Bitcoin, NASDAQ, a rotation out of energy, a rotation out of the yields, all of that will help us start to see financials and the NASDAQ start to turn. Again, it might not happen right away, but those are the clues that I'm watching for. I think if you were to ask for what really needs to happen for me, I actually think energy needs a pause, and we rotate out of energy for a couple of months and back to technology or something like that.
Do you think that's a long-term
No,
bottom, or you're just talking short term?
yeah, I'm talking like months, because I think the oil data, like literally the lack of investment in oil over the last 7 years has been horrible. And government policies have been motivating people to not invest in oil, right? They're trying to get banks not to finance fossil fuels and all that kind of stuff. That's a good idea if you've got a replacement. The problem is the grid is already overwhelmed. And we have some companies, some CEOs from hydro companies or electricity companies, and they're saying if the grid gets to 10% of the cars on electric, we're done. Like, the grid just can't handle that sort of load. So as we push everybody into electric vehicles, it's easy to say no. So stop coal, stop oil, stop whatever, and just push everybody over here. Well, lithium isn't the prettiest subject in the world if you've ever gone to see how it's mined. Lithium is a messy subject, or a messy material, and it's really harsh on the environment. So if we're going to have everybody putting, Tesla battery packs in their house, generators because the grid's not holding up, most of the times the generators are natural gas fired. So you've got this dilemma where we haven't built one side, but we want to push everybody over there. And yet it's easy to turn off coal and turn off oil. So I think we're in this moment where we're sitting here trying to say, well, yes, we all want to be greener, but the problem is nobody's forcing utility companies to be like, I'll say, JP Morgan and the large banks. The large banks are forced to have reserve capacity because they're systemically important. Why we don't have that in the utility sector, I don't know. We allow them to operate with a relative tightness, and then if we have a couple of bad days together, like Texas had, we actually just stall the whole economy for days, and people die because it's either too hot or too cold or whatever. So I think we're going to have to come to this big reckoning really soon about how are we going to get the grid up to speed, or else we've got to stay with fossil fuels, because the density of fossil fuels is much better than the density of solar power or wind power, and the amount of land mass required to get those solar and wind is pretty big. So it's a short-term trade for me. Again, that Excel chart, or that energy chart I showed, was really one of the big things. I think is just saying, okay, we've been on a run for a while here. Let's take some time off, and then again, just a couple months go by or whatever, we get some sort of pullback like we had in July to August, and then we started to work our way higher. And I'm more into an individual energy name than I would go by XLE, but the whole idea is to just stay on the right side of the trade, because in a commodity, you never know when they top, and they top like church spires. They don't top like barns. They don't have a nice rounded top. They have really steep exits. And so for me as a trader, I just want to be in while it's working.
Yeah, and you mentioned the XLE and the fact you wouldn't jump into that. And I think it's really important that everybody knows that when you buy the XLE, when you buy any of these ETFs, you really need to know what these ETFs own. They own a basket of stocks. They're not just, tracking oil prices or, one stock or a group of these stocks. The XLE owns certain individual stocks, and 44% of the XLE right now is in ExxonMobil and Chevron. And these two companies both report their earnings on Friday morning. So just jumping in blindly into the XLE, even after it pulls back, just beware that really what you've got is a really big stake in two of the larger energy companies, XOM and CVX. And like I said, they both report on Friday. So, I kind of like, what you said, Greg, as far as stocks. I mean, just keeping a basket, just looking at individual stocks, finding the stocks you like. And then when you get the right signals going into those stocks might make more sense if you don't have a strong feeling about ExxonMobil and Chevron.
Yeah. The hard part is when things are going up, it's relatively smooth. But just if we take, FCX, Freeport McMoran, everybody thinks we're going to move to electricity, so we need copper. That all makes sense. This was literally $51 on Monday and $41 on Friday. That's 20% haircut in a week in the strongest or one of the strongest sectors in the market. So waiting until you get your sell signal in a commodity is very, very harsh. So it's really important to take profits as you go. And then again, just try to stay with it, but try to take singles and doubles out of the commodities. Don't try for the home run and hold it till 2023 or whatever, when we have the ultimate top in commodities or whatever. I would suggest take your profits as we go.
Yeah. Would you, like on that FCX chart, would you maybe look at a trend line, like connecting the highs and the lows?
Oh, for sure. Yeah. And just let's widen this out a little bit to get a bigger perspective. So FCX topped in May. And what happened there on that day was it put in a huge high volume reversal, sold off, came down, came up here, tested the prior high, pulled back really hard, rallied up, and now we're right back to where we were, May. This was $45, and now we're at 41 or 42. So we've given up a whole year's worth of work in 2 days, or really Thursday, Friday. So my big perspective on these is, like, when you get, some sort of a trend line established or whatever that you can draw under here, you have to take those profits relatively quick. Now, some people will be, well, look at how well the 200-day moving averages work. Do I really want to sell it now? I think the problem we have is if we get this rotation, like I expect we get, out of, I'll call it what's been working lately, into stuff that's oversold, like technology and financials, that reversal will be harsh. And so you're better off to be setting up for the next win, not the last win.
Yeah.
Yeah.
I got it. We're going to have to wrap up the show here in just a minute.
Sure.
But I tell you what, do you have where's your website, or you want to let
Oh, sure.
know how to get a hold of you if they're interested?
One of the important things we've done over the last couple of years here is I've got the screen sharing and I can't get rid of it. There it goes. So it's ospreystrategic.org. And if you head over there, there's a whole bunch of stuff in the free tools, and you can read some articles and videos there. I also write on stock charts, and on stock charts, you can always find my work under the articles tab. And I write like Tom does on the Chart Watchers newsletter. But if you go down, you'll find the Canadian Technician, and that would be some of the work I published on stock charts for over 10 years already. So anyway, thanks for the opportunity to show up today, and good luck with the month ahead.
Yeah, it was great having you here, Greg, not only physically, but also on the show. I'm sure everybody enjoyed it, getting a different perspective. I mean, there's so many great technicians over at Stock Charts, and have so many great friends that I've met through all the work at Stock Charts, and Greg's one of those. So pleasure having you. And I kind of agree. We got some crazy volatility ahead. It's going to be some trying times, I think, over the next several months, and we'll see what happens. We'll continue to watch some of the charts you pointed out, some of the sentiment indicators, and so forth. But let me wrap the show up here with the 3 you must see. And so I'm going to give you, this is going to be a different 3 you must see. Usually I give you 3 different stocks. I'm going to give you 3 different views of one stock. So I'm going to look at IBM. So here is the IBM chart on an hourly basis, just going back over the last month or so. Here was earnings, big volume gap up, continuing to trend higher, so far bouncing off that 20-hour EMA. Things look pretty good in the short term, sideways consolidation breakout. Okay. So yeah, hourly chart, IBM looks as good as any other stock that's reported and beaten results and gapped higher. Then we stretch it out to the daily chart. And now I'm looking back over the last year. And as I look back, I see, well, 140 was a problem there. 140 was a problem here. And guess what? We just reversed at 140. So now all of a sudden that hourly chart, when you look at it on a daily chart, doesn't quite look as good, although there are 2 things on this chart that might be a little different. So number one, you can see that we have now been going up for the last 4 or 5 months on the AD line. So even though price action's been going sideways, we're starting to get signs that maybe IBM is under accumulation. And then when you scroll down to look at IBM relative to its peers, it just set a 52-week high, easily clearing these prior 2 highs. So now it's starting to look a little bit better on the daily. And then I step out to the weekly and I'm like, oh my gosh, 10 years. And here we are at 140. We were over 140 back when this bull market started in 2013. IBM has been one of the worst. Here's your relative strength versus its peer group. It has been one of the worst stocks to own over the last 9 years, while this secular bull market has just exploded to the upside. So which chart do you follow? And honestly, I don't know. I would just say this. If it were to go back down below its key moving averages, I mean, you could look at the weekly, we could go back to the daily. I would say if it can't hold on, I would even say maybe the top of its gap support. I'm going to say 133 to 135. If IBM can't hold that, I want no part of it, because it looks like it's just doing the same thing it's been doing for the last 10 years, 9 years. So IBM, I think, is one of the most interesting because it is starting to show relative strength. It is starting to show signs of accumulation, but it has yet to break out of that 10-year sideways action. So if you're waiting for the ultimate in confirmation on IBM, if it closes above 145, that would take out a 10-year period of consolidation. So this is a chart that I'm keeping an eye on, but I'm a little nervous to jump in at this point, especially given what we're going through in the overall market. Anyway, that's it. Again, I want to thank Greg for stopping by. That was awesome to have him on the show today. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV for your next Trading Places Live. So at 9 o'clock tomorrow, just go over to Stock Charts TV, click on this, and I'll have the next Trading Places Live episode for you. Be careful out there. I tell you, it was a rough end of last week. I don't know where things are going today, but usually the bottom doesn't come when you finish on the low. And that's what we did on Friday. What we need is capitulation. We need a big sell-off, a big rally back. That's what we got back in January. That's what we got in February. That's normally the way these panicked downtrends end, is with a swoosh to the downside followed by some afternoon buying. Until we see that, I'd be a little careful here. Everybody have a great day. Happy trading.